It's a brand new trading week, and the focus this week is on the fallout from Friday's weak U.S. jobs report. The U.S. jobs data was so weak that President Trump decided to fire the person in charge of gathering and analyzing and putting together the jobs data. Whether or not you think that's the right decision, comment below, but the U.S. dollar, which fell sharply on Friday, remains weak. And that, has not necessarily caused an extension in the U.S. dollar weakness, but what it has done has drive U.S. equities higher. Now, the reason why the U.S. Stock market is doing well, despite signs of a weak labor market, is because all of this increases the bets for a September interest rate cut. Now, remember, the Federal Reserve has not cut interest rates at all this year. So they are widely expected to make their very first move next month. And, while we still need to see another jobs report as well as the inflation data, I think at this stage, the market is pretty confident that we are going to see an interest rate cut. So that is positive for stocks because it reduces borrowing costs, makes businesses and consumers their pocketbooks a little looser because the interest income and the interest payments that they're making is a little less. Now, in general, this week we do have U.S. service sector ISM. That is always important. We have a lot of data from other countries like the UK and Canada, but for the U.S., I think it's all going to be about the implications for the jobs report on the Fed policy, along with any kind of announcements related to tariffs. Last Friday, the tariffs, the reciprocal tariffs began. Now, a lot of countries are still in negotiation mode. We're still waiting to see what happens with Canada, for example. So all of that will continue to drive headline risk as well as impact the financial markets. I'm Kathy Lien with BKTraders. I'll do my best to keep you all updated. Make sure that you subscribe to our channel so that you can get all the updates.